Your paycheck looks higher, but your life costs more. Here's why. New money hits the economy at the top: banks, contractors, asset markets, and wages get it last. That's the mechanism, and once you see it, you'll understand how your paycheck can rise while you get poorer. In 3 minutes, you'll see the pipe, start to finish, and what to do about it today. So why don't wages catch up? Because the path of new money is not random. It follows a pipe. Banks receive it first. They lend to those with collateral. Those buyers bid up assets. Prices rise. Only later, much later, does any of that flow reach your paycheck. By then, the cost of housing, healthcare, and education has already moved. You are not imagining this. In 2020, when trillions entered the system, home prices jumped 20% in 18 months. Wages rose 4%. That gap is not a glitch, it is the design. If you are paid first, you win. If you are paid last, you lose. This is not about villains, it is about incentives. When a government owes more than it can tax, it has two choices: default and trigger immediate chaos, or devalue the currency and spread the pain over time. Structurally, the second option is the path of least resistance. It is not personal, but it is predictable. And once you see the pattern, you can position yourself accordingly.
So what changes first? Your job, your rent, or your savings?
The answer is your savings, then your purchasing power, then your job security. By the time your job feels unstable, your wealth has already been cut in half. This is the hidden shift. We have moved from an economy that rewards production to one that rewards proximity to money creation. Think about how you get paid. You work, you wait, you receive. Meanwhile, the money that pays you was created months earlier, spent on assets long before it reached your account. You are receiving the diluted end of the stream. In 60 seconds, I'll show you the pipe. First, one quick story. In 1971, the link between gold and the dollar was broken. Overnight, the constraint on printing money disappeared. What followed was not immediate chaos. It was a slow, steady divergence. Asset prices began a 40-year climb. Wages flattened. The middle class stopped building wealth through savings and started chasing it through debt. That was the trap. And now we are seeing the end game of that cycle. The debt is too large to repay in real value. It must be inflated away. Your paycheck buys less, so the system can pay its bills with cheaper dollars. Here is the pipe, simple and visual. New money is created. It goes to banks and large institutions first. They buy assets, stocks, real estate, commodities. Prices rise. Companies see higher revenues and asset values. Only later, if at all, do wages adjust. And when they do, prices have already moved again. You are always chasing. This is not a theory, it is a sequence, and it repeats every time liquidity expands. But what if you could position yourself earlier in that sequence? Not by getting a job at a bank, but by understanding where value flows and aligning your choices accordingly. That is the pivot. Most people think the solution is to earn more, and earning more helps. But if your income doubles while the cost of housing triples, you are still losing ground. The metric that matters is not your nominal income. It is your ratio of income to essential assets. How many hours do you need to work to buy a square foot of housing, to cover a month of healthcare, to fill a tank of gas? These ratios are deteriorating. Unless you own assets that inflate with the money supply, your labor becomes less valuable relative to the cost of living. So why doesn't the system just fix this? Because fixing it would require choices that are politically and economically painful. Raising rates too high crashes asset markets and triggers recession. Letting inflation run erodes savings and wages. There is no painless exit. The system manages the trade-offs. And in that management, the path of least resistance is to let currency lose value gradually rather than face a sudden break. This is not a secret plan. It is the outcome of competing incentives under extreme debt loads. Now that you see the mask, look at the face beneath it. Why is this accelerating now? The timing is geopolitical. The global system runs on trust in the reserve currency. For decades, the world accepted dollars because they were stable and backed by the largest economy. That trust is fraying. Nations are trading in alternative currencies. They are buying gold. They are settling energy deals outside the dollar system. When demand for the dollar drops, its value drops. To prevent a disorderly decline, policy must make holding cash unattractive. Interest rates stay below true inflation. This pushes you out of savings and into spending or risk-taking. That velocity of money supports the system. Your loss of purchasing power is not a side effect. It is part of the mechanism.
But what happens when the erosion speeds up? This is the question keeping analysts awake. We are entering a period economists call fiscal dominance. That means the Treasury's need to fund deficits starts to drive central bank policy. The government must issue debt to cover spending. If private buyers step back, the central bank absorbs the supply. This expands the balance sheet. More money chases the same goods. Prices rise, wages lag. The loop feeds itself. In this environment, raises cover last year's inflation while prices have already priced in next year's. You are permanently behind. This is not a prediction of collapse. It is an observation of mechanics. A car going downhill will accelerate unless brakes are applied. Our economic car is going downhill with light brakes. The drivers are pressing the gas because they fear stopping more than they fear speed. So where does this leave you? It leaves you in a position where holding labor alone is a losing strategy. You must understand that your time is being swapped for a depreciating asset. Every hour you work, you are paid in ice cubes in a warm room. They look solid when you receive them, but they melt before you can use them. This is why those who build wealth focus on equity, on ownership, on positioning where new money enters. You do not need to become a billionaire to benefit from this insight. You just need to stop bleeding. Let's go deeper into the transfer. How exactly does it happen? Through the bond market. When the government issues debt, someone must buy it. If foreign demand softens, the central bank steps in. It creates reserves to purchase those bonds. This expands bank balance sheets. That new liquidity seeks yield. It flows to assets with collateral: real estate, equities, commodities. Prices rise. The wealthy, who hold these assets, see their net worth grow. The middle class, whose wealth is mostly in wages and bank deposits, sees purchasing power erode. The gap widens. This is not about intelligence or effort. It is about sequence. The vessels that fill first hold more when the rain starts.
In 2020, this played out in real time. The Fed expanded its balance sheet by trillions. Within months, stock markets hit new highs. Home prices surged. Yet median wages barely moved. By the time wage growth became visible in the data, inflation had already accelerated. Those who owned assets before the surge gained. Those who relied on wages alone lost ground. That is the pipe. That is the transfer. You are not imagining it. The data shows it clearly. So why does the system protect assets first? Because the system is functionally designed to prioritize asset stability over wage growth. If wages rose as fast as assets, corporate margins would compress and equity markets would struggle. The incentives align to keep labor costs contained while supporting asset prices. This is not a conspiracy. It is the emergent outcome of a high-debt, low-growth environment. Understanding this is not about assigning blame. It is about navigating reality. You cannot fight the mechanism. You must position within it.
But what changes first? Your perception or your bank account?
Your perception lags. You notice the gas price immediately, the grocery bill, the insurance renewal, but you do not notice the reduction in your pension's real value, or the increased risk in your insurance pool, or the gradual degradation of public services. This lag is functional. It prevents immediate social unrest. If everyone realized today that their future security was being exchanged to fund current deficits, the reaction would be volatile. So the process is slow. Death by 1,000 cuts. A little value taken here, a little there. Over a decade, it compounds into a lifetime of lost wealth. This is why you feel tired. It is not just physical fatigue. It is the psychological weight of running a race where the track stretches beneath your feet.
Now that you see the trap, you must look at the exit. But before we discuss solutions, we must fully understand the trajectory. Where is this going? The current path points toward financial repression. That is, a policy environment where interest rates are held below inflation, while capital controls, or incentives, discourage flight. This transfers wealth from savers to borrowers. The government is the largest borrower. You are the saver. Even if you carry debt, the system as a whole relies on household savings to fund the gap. Financial repression means you accept negative real returns on safe assets. Your savings account, your bonds, your certificates of deposit. They pay 3%, while inflation runs at 5%. You pay a tax just for the privilege of storing your money. This pushes you toward riskier investments just to preserve capital. And if you misstep, if you buy the wrong asset at the wrong time, you lose. The system demands you participate, but the table is tilted. This sounds pessimistic, but it is actually empowering. Once you accept that the game has rules different from what you were taught, you stop playing by the old playbook. You stop expecting fairness from a mechanism designed for stability, not equity. You stop waiting for salvation from institutions whose incentives do not align with yours. You take responsibility for your own value storage. But to do that, you must distinguish between price and value. Price is what you pay. Value is what you keep. In an era of currency debasement, cash is a melting ice cube. Debt can be a tool, if fixed at low rates, but dangerous if variable. Assets are the only lifeboat. But not all assets are created equal. Some are speculative bubbles. Others are stores of value that have survived centuries of currency failures. Knowing the difference is the skill that matters now.
Let's look at the present reality again. Supply chains are reconfiguring. Energy costs are structurally higher due to underinvestment and geopolitical fragmentation. Labor markets are tight, not because wages are high, but because participation has dropped. This creates potential for a wage price spiral. If workers demand higher pay to match inflation, companies raise prices to protect margins, and the loop accelerates. The central bank's only tool to interrupt this is to break demand. They must make you poor enough that you stop spending. This is the cold logic of rate hikes. They do not fix supply. They do not print more oil. They reduce purchasing power until inflation moderates. You are the adjustment variable. Your unemployment or reduced hours is the lever pulled to stabilize the currency.
But what changes first, the policy or the pain? The pain comes first. Policy lags. By the time the central bank acknowledges inflation is persistent, you have already lost a year of purchasing power. By the time they pivot to support growth, the damage is done. This is why you cannot wait for permission to protect yourself. You cannot wait for the news to tell you it is safe to act. The news is incentivized to maintain calm, not to preserve your wealth. Their goal is stability. Your goal is survival. These are not the same. Stability for the system often requires instability for the individual. You must decouple your personal stability from the system's. You must build a lifeboat that floats even if the ship lists. This brings us to the psychological component. Why do we accept this? Why do we not push back? Because the alternative seems worse. The fear of collapse is greater than the pain of erosion. We prefer the slow leak to the explosion. This is a cognitive bias known as loss aversion. We fear losing what we have more than we desire gaining what we could have. The system leverages this. It offers the illusion of safety in exchange for your future value. It tells you to keep your money in the bank, to trust the pension, to rely on social security. These are promises denominated in a currency that is being devalued. They are promises to pay you in dollars that will be worth less in 20 years. It is a contract where only one party holds the pen. Now that you see the contract, you must decide whether to sign it. Most people will not change. They will hear this, feel a spike of anxiety, and return to routine. They will check their balance, sigh, and go back to work. This is the default. It is easier to ignore the slow drain than to confront the complexity of fixing it. But you are not most people. You are listening. You are asking questions. You are looking for the mechanism. This gives you an edge. Not a guarantee, but an advantage. In a world of diminishing returns, an edge is everything. It is the difference between sinking slowly and learning to swim.
The trajectory is set. Debt is too high to repay in real terms. Demographics are too old to drive strong growth. Geopolitics are too fractured for easy cooperation. The only adjustable variable is the value of the currency. It must decline. There is no mathematical path for it to appreciate while maintaining current obligations. This means your paycheck will continue to shrink in real terms. The question is not if, it is how fast, and what you will hold that does not shrink. This is the pivot. Everything discussed so far is diagnosis. The treatment requires action. It requires moving from passive observer to active participant in your own financial defense.
But before we move to action, we must clear a final misconception. Many think this is about getting rich. It is not. It is about not getting poor. In a stable currency regime, saving cash is safe. In this regime, holding only cash is a structural disadvantage. The goal is not to accumulate a large number of dollars. It is to accumulate purchasing power. These are opposites. You can have $1 million and not afford a house. You can have fewer dollars and own the house. The focus must shift from the numerator to the denominator. Stop counting money. Start counting what the money can buy. This shift changes everything. It changes how you save, how you invest, how you work.
In the next section, we translate this into a specific plan. You will know exactly what to do with your next paycheck. You will know how to audit your risk. You will know how to build a shield that lasts. But first, internalize the reality. The shrinkage is not a glitch. It is the system functioning as designed. Your paycheck is shrinking starting now. Not next year, not when the news says so. Now. Every day you wait is a day your labor is exchanged for less reality. This is the hard truth. It is uncomfortable. It is heavy. But it is the ground you must stand on to build something that lasts. The mechanism is clear. The trajectory is visible. The risk is personal. Now we turn to agency. How do you move within this system without being crushed by it? How do you turn knowledge of the shrinkage into a shield? This is not about fear. Fear paralyzes. This is about clarity. Clarity acts. You need a plan that accounts for continued debasement. You need a plan that assumes your wages will lag. You need a plan that does not rely on external salvation. Because functionally, the system is incentivized to preserve itself, not your individual purchasing power. You cannot ask the mechanism to spare you when its survival depends on dilution. You must learn to navigate the current. You must grow your own value. So what does that look like in practice? It looks like diversifying away from single currency risk. It looks like acquiring assets that have no counterparty risk. It looks like investing in yourself so thoroughly that your labor becomes scarce. It looks like reducing your dependency on the system for your basic needs. The more you need the system, the more vulnerable you are to its manipulation. The less you need, the more freedom you have. This is the ultimate hedge: independence. Not just financial independence, but functional independence. The ability to provide value directly to other humans without going through a corporate or government intermediary. When you cut out the middleman, you cut out the layer where value is extracted. You keep more of what you create. In 2022, when inflation hit 40-year highs, who survived best? Not the person with the highest salary, not the person with the most savings in a bank account. The person who owned a small business with pricing power. The person who held real assets that produced cash flow. The person whose skills were in such demand that they could renegotiate their rate on the spot. That is the pattern. Ownership beats wages. Scarcity beats availability. Pricing power beats permission. But what changes first, your spending or your earning? Both. You must attack from both sides. On the spending side, cut the leaks, the subscriptions you do not use, the fees you do not notice, the impulse buys that drain your account. These are small cuts, but they add up. More importantly, reduce your dependency on the system for your happiness. The more you need to buy to feel okay, the more vulnerable you are to inflation. Cultivate sources of satisfaction that are not for sale. Relationships, health, knowledge, nature. These are inflation-proof. They cannot be debased. They grow more valuable the more you invest in them. This is the ultimate hedge. A rich life does not require a rich bank account. It requires a rich set of priorities. On the earning side, you must increase your pricing power. In a world of diluted currency, labor is a commodity unless you make it scarce. How do you make your labor scarce? By specializing, by solving hard problems, by building a reputation for results that cannot be easily replicated. The market pays for uniqueness, not for effort. You can work 80 hours a week at a job anyone could do and still struggle. Or you can work 20 hours a week solving a critical problem for a business and thrive. The difference is leverage. Your time is your most non-renewable resource. Do not sell it cheap. Do not sell it to those who do not value it. Sell it to those who understand that your skill saves them money, makes them money, or protects them from risk. Charge accordingly. And when inflation rises, raise your prices. If you are an employee, this means negotiating. If you are a business owner, this means adjusting. If you are a freelancer, this means updating your rates. Do not apologize. The currency is worth less. Your work is worth the same. Adjust the number. So how do you start without getting overwhelmed? Here is your action plan for this week. 3 moves. Simple, specific, doable. First, audit your exposure. Write down where every dollar of your net worth is stored. If more than half is in cash, bank accounts, or traditional retirement funds denominated in your home currency, you are overexposed. You do not need to fix it today, you just need to see it. Awareness is the first step. Second, shift 5%. Take 5% of your next paycheck and move it into an asset that cannot be printed. A share of a productive business, a piece of real estate through a REIT, a small amount of physical gold, a course that upgrades your earning power. The amount does not matter. The direction does. Start the flow. Third, build pricing power. Identify one skill you have that solves a real problem. Then find one way to charge more for it. Raise your rate. Add a premium service. Package your knowledge. Ask for the raise. The worst they can say is no. But if you do not ask, the answer is already no. And the currency is already worth less. These 3 steps will not make you rich overnight, but they will change your trajectory. They will move you from passive recipient to active participant. They will align your actions with the reality of the mechanism. And that alignment is everything. Because the mechanism does not care about your intentions. It only responds to your position. Position yourself where value flows, not where it drains. But what if you make a mistake? What if you buy the wrong asset? What if you raise your rate and lose a client? This is where most people freeze. They wait for perfect information. They wait for certainty. But certainty does not exist in a dynamic system. The goal is not perfection. The goal is direction. A small step in the right direction compounds. A large step in the wrong direction can be corrected, but no step at all guarantees erosion. So start small. Start now. Adjust as you learn. The market rewards those who adapt, not those who wait. Now let's close the loop. You now know the mechanism. New money enters at the top, assets inflate first, wages adjust last. You now know the risk. Staying in cash means accepting guaranteed erosion. You now know the action. Audit your exposure, shift a portion into real assets, and build pricing power in your labor. This is not theory. This is the playbook for navigating a world where currency is a tool of policy, not a store of value. Mechanism.
paid last. Risk, staying in cash. Action, shift 5% and build pricing power. The system is not evil. It is not a conspiracy. It is a set of incentives, and incentives can be navigated. You do not need to overthrow the system. You do not need to predict the next crash. You just need to understand the current and swim with it, not against it. Your paycheck may shrink, but your wealth does not have to. Your freedom does not have to. Your future does not have to. So as you move forward, carry this one phrase with you. Let it guide your decisions when the path is unclear. Let it anchor you when the noise is loud. Let it remind you of what is truly at stake. Your paycheck is not your worth. Your wealth is your freedom. Guard it.